All right, so what if you read Schiller in March of 2000 and you followed his, I don't say his recommendations, but you bought his theory that the market was irrationally exuberant, and then you got out. You said, I'm getting out. And so you put your money from the S&P 500 into Ginnie Mae. We'll just use Ginnie Mae for example. So here's the S&P 500 in red at the beginning of 2000. Here's a Ginnie Mae in blue. And you can see quite the difference there, huh? So basically we started with $100,000 in the beginning of 2000. And Ginnie Mae was worth $183,000 at the end of the decade. S&P 500 was only worth $90,000 at the end of the decade. All right, so you saved yourself a significant downturn. You made, you basically $100,000 more without all this risk. And don't forget, at the end of 2009, February 2009, you were down to $58,000. That's without taking money out or anything. So you would have been proven to be correct. And this is where I think a lot of people kind of jumped on the Schiller bandwagon, because this is actually right here is when people, he had people avoid, theoretically, the down market. So basically at the end of 2002, you would have had $60,000 in the S&P 500, where you would have had $133,000 in Ginnie Mae, the bond funds. Because remember, Schiller said he had no stocks whatsoever for the most part. That's not the whole story. The whole story is actually he started writing about irrational exuberance in the 1995s. All right, and we'll even say 1996. So that's when he met with Greenspan. So that's not the whole story. So we go to what would have happened if you would have missed the 90s, the latter part of the 90s, which was huge run-ups. Remember, Ginnie Mae is going to be in blue, and the S&P 500 is going to be in red. So you can see right here, if you had started reading Schiller in the mid-90s, your $100,000 in the S&P 500 at the end of 2000, right there, at the end of January 2000, was worth $242,000. You would have done almost 2.5 times your money. Ginnie Mae is worth $123,000. And I'm just using Ginnie Mae because it's the bond fund guaranteed by the government. So you would have done incredibly well in the S&P 500. You would have missed out on all this right here if you would have been following Schiller from the mid-90s. So he called it too early, but just no one knew about it because his book didn't come out until March of 2000. But no one even talked about it in March of 2000. Why? Because everyone's like, no one knew we're in the downside. It's only that they started talking about Schiller in the latter part of probably 2002 and 2003. Anyway, long story short, even then, when all was said and done, at the end of 2000 and March of 2003, S&P 500 is still up to 153. So over the course of the next, you still made 50% on your money from 1996 to 2003. So we take our trusty calculator and we say, okay, what's that? 96, 97, 98, 99, 2000, 1, and 2. We have 7 years. So we say, okay, we started $100,000 as our present value. We have 7 years of N. Didn't make any payments. We ended up with 153 future value. We still made 6.2% a year annually, my friends. And that's with the decline of 2000, from 2000, 2001, and 2. You still made freaking 6.2% annualized from 1996 on. That, again, the irrational exuberance, he didn't call it. And look, I'm not here to bash Schiller. Can we all acknowledge he did not call it the way everyone seems to think. All right, so then the S&P 500 is in the red. We're going up to 2000 and right here. So at the end of 2009, you're down to 148. All right, so you're basically below where you started with. Well, not where you started with, but you're below where you were in 2002 for the most part. So you're down to 148. All right, so now we say at the end of 96 to 2009, that's 13 years. All right, so we're gonna go 13, and 148 is our future value. We made 3% a year at that point. That's it. That's it. We only made 3% a year. But then watch, literally within the next year, we're right back. I mean, we're right back to where we were. So this run up right here, he went from 3% a year to hold on a second. to 6.4. You've doubled your rate of return over. This is the amazing thing about the markets, man. You had to be in it. If you were out right here, if you were in the market right here, you're like, man, I've had the market for basically 14 years. I've only made 3% a year. If you just held on to the end of the year, you would have doubled your rate of return from 3 to 6.4. Nuts. All right, so let's just keep going back here. So that was from there. So now let's just say, okay, so he fell into rational exuberance. We just proved right there once and for all that, you know, Schiller, and I'm here to say the naysayers, they're never right on both sides. They aren't. So now let's do, if we would have had a portfolio where we did 50% in Ginnie Mae, this would kind of be a barbell. We're not going to rebalance. And 50% in S&P 500, yeah, no rebalancing. Okay. So let's go here, and we'll say from 1996. All right, so here we're doing no rebalancing, just 50%, 50%. That's it. And what we're going to find is this will be the yellow portfolio, and you can see they converge all at the same thing. So 14 years later, essentially, or 13 years later, they're basically all at the same place, all about 227, 229, 220. Look how amazing. I mean, that's actually quite amazing when you think about it. The markets got destroyed a couple times. They also had huge gains a couple times, and yet look at that. They're all converged around the same thing, right about 229, 230. Now, if we were to rebalance, let's go to 2003. All right. And well, not rebalance. If we just had a split portfolio to 2003, we'll see where, and we're using Portfolio Visualizer, by the way. So this is a balanced portfolio from 1996 to 2003. The balance is in the yellow. So the S&P 500 was at, actually, what is the S&P 500? Was portfolio, wait, which one is which? Portfolio 1 is Ginnie Mae, portfolio 2 is S&P. Okay, so this is portfolio 2, that's the S&P 500. All right. Yeah, portfolio 2 right there. So at the end of 2003, we went from 100,000 to 203 in the S&P 500, 167 in Ginnie Mae, and 185 in the balanced portfolio. At the end of 2002, September 2002, at the market, essentially market decline. It's actually right here is the end of March of 2003. S&P 500 is still worth most, 165, which beat everything else. So you can see with a balanced portfolio, the S&P 500, with a balanced portfolio, at the down market, you were glad you were in a balanced portfolio. However, on the up markets, at the end of March of 2000, S&P 500 was at 260. The balanced portfolio was at 193, and Ginnie Mae is at 127. I'm just telling you right now, no one is sitting here in March of 2000 saying, I need that balanced portfolio. No one was. I'm just telling you right now. But then we go to the end of 2003. Again, the S&P 500 reclaimed its crown. Now, if we go to end of 2009, right here, we'll see again the balanced portfolio saved you when the markets were down. And let's see what we got here, right here. The balanced portfolio, it doesn't let's do it. But if we go to March of 2009, at the bottom, now this only goes as February, but still you can see the balanced portfolio was at 182, S&P 500 is at 148, Ginnie Mae was at 217. All right, so I mean the balanced portfolio looks like it's good when the markets get hammered, but at the end of the day, the Ginnie Mae would have been better, but no one knew. That's the thing, no one knows. But then the S&P 500 comes storming back. It's crazy. But now we go and say, what if we only invested in 2000? And this is where it gets risky, man. I'm telling you, this is no joke. If you retired in 2000, you put your money in the market because everyone's saying the market. Look at this. S&P 500 at the end of 2009 is only worth $90,000. The balanced portfolio at the end of 2009 is worth 136. The Ginnie Mae is worth 183. So, I mean, again, the balanced portfolio did exactly what it's supposed to do. It gave you some downside protection. Literally, it did. You know, a couple times it dropped below your starting in 2001, it was down to 97,000. In 2002, it was down to 93,000. That's it. After that, it was always above your starting point. Now, if we end up this, we go to 2020, and I actually haven't seen this, so it'll be interesting to see because the last 10 years are insane good for that market, so the S&P 500. Let's see what we got. Okay, so now if we're at the beginning of 2000 to the end of 2020, the S&P 500 is worth 374, but the balanced portfolio is worth 318. It's not a bad trade-off, man. Not a bad trade-off. I mean, you sacrificed 60,000 bucks, but you were able to get to slice all that volatility. Not a bad trade. J May is still at 261. That's not bad. I mean, still more than doubled your money. But let's say we start in 2010, right? Let's see what we got here. Yeah, the S&P 500 smoked the balanced portfolio. S&P 500 is quadrupled, balanced portfolio almost tripled, and the Ginnie Mae is basically at 143. All right, so that's the challenge that we're dealing with. The Ginnie Mae basically hasn't done anything. In fact, we can see what the Ginnie Mae return is going to mean. It's going to be not much. I'll tell you that right now. 143. Yeah, that's over 10 years. Ginnie Mae's averaged 3.6% a year. S&P 415. S&P 500's averaged 15.2. Balanced portfolio average 10.8. I mean, that's, if I was retired, I'm taking the 10.8 any day of the week. Yeah, well, I hope this helps. I find that interesting. You know, the market prognosticators, no one knows nothing. They don't. The balance, I mean, I'll do another video where I talk about what you should be looking at going forward, because I think this should say something to you if retirement is imminent. All right, we'll see you.